When you buy a mutual fund, you probably think it's pretty simple, right? You pick a category, say a large cap fund, and you expect the manager to just stick to that plan. But what if I told you there's a hidden strategy going on behind the scenes, one that could seriously impact your returns? Well, in this explainer, we're going to pull back the curtain and show you what's really happening inside your mutual fund.
All right, here's our game plan. First, we'll look at how a mutual fund is supposed to work, the machine, so to speak. Then we'll get into the fun stuff, how managers actually steer the ship and how often they go off course. After that, we'll ask the big question, does it even work? And finally, we'll wrap up with why all of this really matters for you and your investments.
Okay, so first things first. Let's talk about the official blueprint of a mutual fund. This is the kind of stuff you'd find buried in those super long, super boring legal documents, the ones with all the fine print that, let's be honest, nobody actually reads.
So on paper, it's this really neat three-part system. You've got the sponsor, who puts up the seed money to get things started. Then you have the trustee, who's kind of like the referee, making sure everyone plays by the rules and protecting your interests. And finally, there's the AMC, the asset management company. These are the folks who make the day-to-day calls on what to buy and sell. It's a whole system of checks and balances, all designed to be super stable.
And the whole point of this setup, it's all about rules. It's meant to create this feeling of safety and predictability. If you want to make any major changes to the fund, you can't just do it. You need to get formal consent. The whole thing is designed to feel rock solid.
So we have this fortress of rules, this rigid structure. But what about the strategy happening inside that fortress? Is it just as fixed? This is where things start to get really interesting.
And that just leads to the critical question, right? Is the fund manager, the person actually running the show, just following a strict, unchangeable script? Or are they improvising a little, reacting to what the market is doing? And this brings us to this fantastic concept called style drift. Some people call it risk shifting. I like to think of it like this. Imagine a chef who's famous for a very specific beef stew. But one morning, the butcher has this incredible fresh lamb for a great price. A smart chef might decide to subtly change the recipe for the day to use that amazing lamb, even if the menu still says stew. That's style drift. It's the fund manager adapting to what the market gives them. So, you're probably wondering, is this some rare thing that only a few managers do, or is it happening all the time? Well, a really detailed study decided to dig into hundreds of Indian equity funds to find out for sure.
And what they found was kind of staggering. Across just 160 funds, they found a whopping 473 style breaks. These are significant, measurable shifts in strategy. So yeah, this is not a rare event. It's happening constantly.
And check this out. It wasn't just a few rogue funds making all the changes. You can see from the data right here that tons of funds made multiple shifts over time. They were constantly tweaking, constantly adopting their game plan.
Now, it's important to know that these shifts kind of come in two different flavors. You have style rotation, which is a huge change. Think of a fund that's supposed to buy big company stocks suddenly buying tiny ones. That's pretty rare. What's much more common is style drift, which is more of a moderate, subtle shift.
Okay, here it is, the billion-dollar question. All of this shifting, all of this maneuvering, does it actually help you make more money? Or is it just managers tinkering around for the sake of it?
I mean, when a manager drifts away from what they said they'd do, are they being a genius and skillfully navigating the markets? Or are they just taking on a bunch of new risks you didn't sign up for?
Well, believe it or not, the data gives us a surprisingly clear answer. Take a look at this. The funds that made zero changes, they actually had weaker performance. And the funds that shifted way too often, their returns started to fizzle out. But right there in the middle, the funds with a moderate, tactical amount of shifting, they consistently outperform the rest. That's the sweet spot.
And this is really the core takeaway from the study. It's basically saying that a great fund manager isn't just a great stock picker. Their real skill lies in knowing when and how to adjust the strategy. That ability to adapt, but not too much, seems to be a key ingredient for success.
Okay, so we've waded through all the data and the concepts, but what does this actually mean for you, the investor, looking at your own portfolio?
Well, the biggest takeaway is this. You're not just investing in a simple category label. You're investing in a manager's active living strategy. The fund's name is just the beginning of the story. A manager's ability to adapt can be a huge strength, but you also have to realize that it means the fund you own today might be taking on different kinds of risks than it was a year ago.
So really, it all boils down to this question. When you look at your portfolio, what do you want? Do you want a manager who just rigidly sticks to the original script no matter what?
Or do you want a skilled pilot who knows when it's time to improvise and navigate through whatever the market throws at them? The answer to that could make all the difference to your bottom line.